A look at the top global oil news for you. Amid continued efforts to reach a ceasefire in Gaza, global oil prices have remained relatively stable, but with the U.S. launching airstrikes on Syria and Iraq, prices have jumped. Yet it is global production predictions that had more of an impact on prices. On Tuesday, oil rose over $1 a barrel as the U.S. crude production is expected to be flat this year. At the same time, the head of OPEC has said that the global oil market will need $14 trillion in money over the next 2 decades if producing nations are to meet global energy demands. And still, oil giants continue to post better than expected earnings. The latest, BP. John Terrett has more.
It is fair to say that BP British Petroleum is not really the flavor of the month in America, and it hasn't been ever since 2010, when the Deepwater Horizon accident happened, killing 11 people, injuring 17, and flooding the Gulf of Mexico with crude oil for weeks on end. Then, of course, recently, Bernard Looney, who was the CEO of BP, had to resign his position because he was not fully transparent with relationships. He'd had personal relationships, allegedly, with members of his staff. So BP's never really far from the headlines, and with its latest set of earnings, it continues that tradition. It's boosting its shareholder returns. It's going to accelerate share buybacks. BP says it intends to execute, by the end of the first quarter, a buyback of $1.75 billion. By the end of the first half of 2024, a buyback of $3.5 billion. It's committed to that, says the company. It's also boosting its dividend by 10% for the fourth quarter to $7.27 per share. Now, BP gave us what they call proxy net profits. In other words, it's underlying replacement cost profit. I don't know what that means, but I've got a pretty good idea. This is for the whole of 2023. The company made $13.8 billion, but it was $27.7 billion the time before, so that's quite a lot less. However, for the fourth quarter, the last 3 months of the year, BP did turn in a net profit of $3 billion, not $2.6 billion, which Wall Street had been anticipating. So that is a big beat. And BP, which is largely, although it's an international company, we think of it really as a UK company, its latest set of earnings and all this news comes just days after the 2 big oil majors here, Exxon and Chevron, beat Wall Street expectations, in part because of increased shale oil production that has offset what is seen as quite a low crude oil price. A lot of people wondering why crude oil isn't a lot more expensive given the situation in the Middle East, and the answer is that the crude oil industry and analysts appear to be waiting to see what happens regarding the several things that are happening in the region. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more things on all oil, Matt Smith, lead oil analyst at Kepler. Good to see you, my friend. Help me out here. When the Red Sea conflict began and to where it is today, a lot of people thought oil prices would essentially spike up significantly higher than it is right now. Why is it not higher?
Well, Phil, in a nutshell, what we have is a situation where we haven't lost supply from the global market. If you think of it as one big bucket of supply, nothing has really been lost from that. What we have had is dislocations, some diversions, but we also still have the oil flowing through the Red Sea to a certain extent, not the same as it was before. And so you are seeing opportunity costs because of these diversions. You're seeing freight rates go up. You're seeing insurance costs increasing, but that actual specific price of oil hasn't been going up because we're not seeing supply being disrupted. If that were to happen, yes, we would likely see prices really pushing higher. But because that hasn't happened yet, that's why we continue to remain essentially mired in the 70s here.
Are the positive earnings that we see from BP and other oil companies a reflection on their, I guess, due diligence on controlling costs and making sure they run an effective company? Or is it the fact that we're seeing demand growth globally when it comes to oil products?
It's both, Phil. So yes, they've been very much a bit focused in terms of making sure that they're applying themselves, being conservative. Perhaps, you know, oil is so typical for being boom and bust, but they've been very careful in terms of that capex to a certain extent. They've made a lot of trading profits too. But to the second point, oil demand growth is going to be over 1 million barrels per day this year. We were much higher than that last year. The year after this, we're going to be 1 million barrels a day or more in terms of demand growth. So that will continue there. The thing is, if we just look at BP in 2022 had, you know, really strong earnings, and 2023 wasn't quite as good, but oil prices were still at, they averaged just over $80 on a Brent basis there. So oil prices in the grand scheme of things are still relatively high. We've just been used to them being even higher in recent years because of everything that happened with Russia and Ukraine. So you still have BP, Exxon, Chevron coming through with really strong earnings, trading profits there, but also just because that cost of the revenues they're making on that cost of the barrel is still pretty strong.
And then there's the nat gas market, right? Because people often talk about if you have a very cold winter, that benefits nat gas because that's used in heating a lot of homes. And also in the summertime, if you have a hot summer, that's used for air conditioning as well. What should we expect from at least the nat gas perspective?
Well, we had this cold burst just a week or so ago in the US, and that caused natural gas prices to rally, you know, because you see such a spike in demand coming through there. And then they've come right back off again because we've basically made it through the peak of the bleak midwinter here. And so just as we are with oil production at a record, natural gas production is also pushing up to a record as well around that level. And so we are plentiful in terms of production and supply. Inventories, those storage levels are really strong as well. So natural gas isn't quite the same in the same realm as we are with oil, in that it's much more influenced by the domestic situation. Even though the US is exporting LNG, liquefied natural gas, at a record here, we still have so much supply. It's very much more a domestic thing, and that's why prices are remaining lower. Whereas oil prices, gasoline prices too in the US, are very much at the mercy of global factors on more of a basis.
I mean, I think it's an absolutely fascinating sector. We could spend hours talking about this. I've spent many hours studying it, and I still don't fully understand it. Explain to us from an investor perspective, when they say to invest upstream or downstream or midstream, are there certain companies that you think will likely benefit from the current situation over the next year or two?
Oh my gosh. From the downstream, so that's your refiners, we're in a situation where diesel is most in demand right now. So in terms of gasoline, it's fairly plentiful, but because of sanctions on Russia and also because of the Red Sea dislocations, diesel prices are relatively more expensive than gasoline and oil prices, to be honest. And so that the crack spread, the profitability of refining diesel is very strong. And so any of those refiners that are producing a lot of diesel are going to be in a good situation for this year here, because Europe is needing to pull in as much diesel as it can. It's struggling to get it through the Red Sea and the Suez Canal, and it's struggling to get it because it can't get it from Russia anymore. So, but you know, if we do have some geopolitical tension, if we do see, say, the Strait of Hormuz in the Mideast Gulf there, if that got blocked for a period of time, that would cause all prices to spike. So whether it's oil or gasoline or diesel, everything would rise. And so, barring geopolitical concerns, prices should remain fairly close to the level that we're at here now, which is a fairly decent level for refiners and for producers. And so it's a fairly good sweet spot for upstream, midstream, and downstream.
It's such a dynamic industry. You've got the political aspect of it, the economic aspect of it, the individual country aspect of it. We can go on, but I really appreciate your time trying to help us better understand what we have to look forward to for the rest of the year. Thank you.
Thanks, Phil.